Hi everyone, Archana here, and today on day 114 of our 365-day financial fitness challenge, we are diving into the world of mutual funds, specifically focusing on how a long-term approach can benefit you compared to short-term strategies. First of all, let's talk about the power of patience. Long term wins in mutual funds. How? Imagine you are planting a money tree. With a long term view, you nurture it, watching it grow steadily over the years. That's the essence of long term investing in mutual funds. You pool your money with others to buy a basket of investments like stocks and bonds. The key is to hold them for a longer period, typically over 5 to 10 years or more. Here is why this patient approach is powerful. Let's talk about compounding. This is like magic in investing. Your returns earn returns, snowballing your growth over time. The longer you invest, the stronger this effect becomes. Let's say you invest rupees 10,000 annually into a mutual fund with a 7% average return. After 10 years, you will have roughly around 1,49,593. But that's not all. A significant portion of that amount, that is 42,593, comes from compound interest earned on your initial investments and the returns they generated over time. Second, market fluctuations. Markets have ups and downs, but history shows a general upward trend. By staying invested for the long term, you ride out the short term dips and benefit from the overall growth. Think think of it like this, imagine buying a stock during a temporary dip. Over time, as the market recovers and the stock price climbs, you will be glad you held on. Third, reduce stress. Short term investing can be a roller coaster. Constantly monitoring prices and reacting to every swing can be nerve wracking. Long term investing allows you to set a course, make adjustments periodically, and avoid getting caught up in the daily market noise. Now, let's talk about short term strategies. Short term investing aims to capitalize on quick movements in the market. People might buy and sell within days or weeks, hoping to snag a quick profit. This can be tempting, but it's important to understand the flip side. There can be higher risk. Short term markets are more volatile, meaning prices can swing dramatically. This can lead to losses if you're not careful. Imagine you buy a stock that dips slightly one day, thinking it will rebound soon. But what if the price keeps falling? In the short term, it's difficult to predict these movements, and you could end up selling at a loss. Second reason is active management. Short term strategies often require constant monitoring and adjustments. You need to be glued to the markets, tracking prices and news that might affect your investments. This can be time consuming and stressful, especially for beginners. Next drawback is emotional decisions. The fast paced nature of the short term investing can lead to emotional decisions. You might panic and sell during a downturn, lock in losses, or get overconfident and buy into hype without proper research. The next drawback can be fees and taxes. Short term trading often involves frequent buying and selling, which can incur transaction fees and potentially higher taxes on short term capital gain. These can eat up into your returns. Let's make it real. Imagine you invest in a mutual fund that grows at an average of 8% annually. Here is the difference in the returns over time. Over 5 years, your 1 lakh invested can roughly become 1 lakh 49,000. With 10 years, 1 lakh can become 2 lakh 19,000. The longer you hold, the more significant is the growth. So, the takeaway, mutual funds offer a great way to build wealth for the future. While short term strategies can be alluring, a long term approach with a focus on compounding and weathering market dips is generally a safer and more rewarding path for most investors. Remember, align your strategy with your goals. Are you saving for retirement or a down payment? Do your research, understand the risk, and choose funds that suit your investment horizon. And seek professional guidance if needed. Financial advisors can help you create a personalized investment plan. By taking a long term view with mutual funds, you can watch your money. By taking a long term view with mutual funds, you can watch your money tree flourish. Thank you for being with me today and happy investing. See you tomorrow.